And if you go back to March of 2020, Bitcoin fell 50% in like 12 hours or whatever it was. And I'm off a little bit, but hit 50 something, 5,200. And people are like, oh, it's going to zero. I'm like, no, this is a big buying opportunity.
Hello, and welcome back to the Daily Crypto. Today we have Mark Yusko as he educates us about the real opportunity Bitcoin's crash, along with other cryptocurrencies, is bringing to the table. The first loss, best loss believer sees the crypto dips as an excellent investment opportunity. Using the principle of buy the dip, Mark Yusko based his guess on the assumption that the price drops are temporary aberrations that right themselves over time. Dip purchasers are in the hope to exploit dips by purchasing at a relative discount and reaping the rewards when there is a rise in prices again. Without further ado, let us get right through the video. Remember to like and subscribe if you enjoy the content we produce on this channel.
When you can create something out of thin air, whether it's money, right, like my shirt, or whether it is a barrel of oil, a brick of gold, or a Bitcoin, that creates a problem with supply. Right? In the old days, if I want to sell you a barrel of oil, I actually had to have a barrel of oil that I controlled. I couldn't just say, oh, well, I'm going to make a paper barrel of oil and sell it to you. And as long as we settle up before I have to deliver it, I'm all good. So if you look at oil prices, they're super volatile, particularly when they spike because people just keep issuing new paper barrels of oil. And then you're prone to a period of speculators coming in and pushing the price down through shorting. And I think that's exactly what's happening in Bitcoin right now.
Because crypto markets are unpredictable, purchasing cryptocurrencies at any price, let alone a drop that might become a long-term trend, is dangerous. Prices may rebound to former levels, but they may potentially fall farther, leaving your investment underwater. If history is a prologue, the current slump had fallen to a similar level before prices returned to pre-slump levels and rebounded like last year, 2021, when it peaked in the autumn. There is likely to be, but of course they might not. Bitcoin values, for instance, have demonstrated some seasonality so far, appearing to dip in value to varying degrees in the spring before rebounding in early summer. However, like with any investment, especially in the volatile realm of cryptocurrencies, previous success is no guarantee of future outcomes.
And if you go back to March of 2020, Bitcoin fell 50% in like 12 hours or whatever it was. And I'm off a little bit, but hit 50 something, 5,200. And people are like, oh, it's going to zero. I'm like, no, this is a big buying opportunity. And you've heard me say this, right? Investing, only business I know. When things go on sale, people run out of the store. When you put anything on sale, put wedding dresses on sale, people will people will run over each other to get in the store to buy the stuff. But when stuff goes on sale in the markets, ooh, I'm out. And the further the price goes down, the faster they run away. Like, no, that doesn't make any sense. And I'm a big believer that the first loss is the best loss. People say, well, that doesn't make sense. You're saying buy things that go down. I'm like, no. First loss is the best loss if you bought something because you don't understand it. And if you bought it because the price is going up, then you better sell it soon. If you bought it because you think the price is below the value, then you should definitely buy more. And that's a very big difference between an investor and a trader / speculator, or worse, gambler. And that's, I think, the problem we have right now is we're still getting rid of the gamblers.
Bitcoin gained over 70% before the end of 2021. That's an incredible return for any asset class, let alone one with no actual worth or the complete confidence and credit of a national economy backing it up. Nonetheless, a 70% yearly return is a bit of a letdown for Bitcoin after gaining more than 300% in the lockdown-ravaged year of 2020. The Federal Reserve is confronting a record increase in inflation that rivals anything experienced in the previous 4 decades. It is unknown how many rate rises are left, but economists expect the central bank to continue hiking rates until the end of the year and into 2023. According to some forecasts, the federal funds rate might close the year at or over 3%. As cryptocurrency usage grows, so are cryptocurrency regulations put in place worldwide to oversee it. cryptocurrency prices plummeted last year after China's central bank reiterated a blanket ban on digital asset transactions, prompting some experts to warn that the harsh rhetoric may encourage other countries to take similar measures. In contrast, others noted that prices have quickly recovered in the past following such announcements. Weighing in on the ban regulation on China and the toll it made on Bitcoin prices last year, Mark Yusko said,
"But the difference is, in the old world of innovation, where it was pretty localized, each jurisdiction had their set of rules and regulations because nation states mattered and borders mattered. That changes in crypto because now nation states are not quite as important. Borders don't really exist. I mean, what is the border of the metaverse? And if you think about, take China. China says, I'm going to ban exchanges, 2017. Price of Bitcoin falls 40% almost overnight, and everybody freaks out. And what happened? Those exchanges picked up and moved to Japan and South Korea. And within weeks, the hash rate is right back to the same. Same thing with Bitcoin mining. Last year. We're going to ban miners. What did they do? They picked up, moved here to Texas, moved to Kazakhstan. I met a guy down in Miami who was one of the Kazakhs who built this giant mining facility with all the people that came out of China. And it turns out some of them stayed in China. If the recent data shows that they're actually still doing mining in China. And we freak out about this idea that regulators are going to, but the thing is, if you over-regulate, if you try to put it in a cage, what's going to happen, it's like squeezing a balloon. The air is just going to go somewhere else.
Historically, cryptocurrency exchanges have been opaque, allowing their operators to earn profits without governmental supervision or responsibility. Many exchanges have been accused of wash trading, front-running, or freezing customer accounts.
40% of people on the planet, which is 2.8 billion people or 2.9 billion people, don't have a bank account. Yet they don't need a bank account now, because in the old days, if I want to send you money, you had to have a bank account, and I had to have a bank account, paid a fee. Now, if I want to send you money, all I have to do is have a wallet, I send you money. And all of these innovations are gonna happen. That's the cool part, right? And that's why I say back to the, first they ignore you, then they laugh at you, then they fight you. Cool part is, we've already won. Is that we don't even have to wait to win. We've already won. And yes, the volatility sucks. And yes, I feel less rich. Well, part of it is, someone asked me this question. So, I'm all about calm. Calm is an edge. So how do you stay calm? I said, well, one, diversification. I don't have all my eggs in one basket. I have a lot of baskets, or a lot of eggs in the basket, and I wash the basket. Two is constantly dollar cost averaging and rebalancing, selling the stuff that goes up and buying the stuff that goes down when it's cheap. And then there's just a discipline to wanting to focus on where the innovation is happening. This innovation is an asset class. And the amount of innovation in this space is, again, it's unprecedented. It's because the talent migration is unprecedented.
Crypto exchanges registered with the SEC must have technological solutions that make their order books audit compliant. They would also be subject to tight order execution procedures to avoid market manipulation. Let us listen to what Mark Yusko says about the regulation of Bitcoin.
This idea that regulators here are going to set the rules is crazy, because if you make the barriers or the boundaries too small, it will just push innovation outside. And what I do like is under Jay Clayton, the SEC was measured, prudent, consistent. Like, those are not words that people today would use. Current head, not as much, but you do have people, like even the executive order is actually pretty good. Let's study this.
Totally reasonable. Hey,
let's figure it out, and let's combine. And then you got Senator Lummis and others that are really smart about this. But ultimately, we're going to choose as a country. We're going to choose whether we want to be in favor of innovation and wealth creation, or we want to be against it. Now, our track record on it is not actually very good, right? Taxation is a good example, right? Why would you ever tax innovation and wealth creation? Why would you tax income? It makes absolutely no sense. I mean, it just makes no sense. And it was supposed to be temporary, you know, for the War of 1812 or whatever it was, Spanish-American War. But it's not temporary. What we should tax is consumption, because you should let people make as much money as they want and create as many jobs as they want.
Dollar cost averaging into an asset, according to Mark Yusko, is the most effective approach to implementing a long-term investment strategy. Bitcoin is no different. DCA is an excellent technique for investors with low risk tolerance. If you have a large quantity of money to invest and put it all in at once, you risk buying at a high, which can be uncomfortable if values decline. The possibility of this price decline is referred to as a timing risk. With DCA, that lump sum may be thrown into the market in smaller increments, minimizing the risk and impact of any single market move by spreading the investment out over time. According to the hedge fund manager, buying a small amount each day or week will result in more significant returns than attempting to predict the market. You get the best deals, the worst prices, and everything between when you purchase daily. Using DCA method for Bitcoin serves three purposes: getting the best average price on Bitcoin, saving time, and reducing the fear of losing out.
If you're buying an asset truly for a long duration, you know, to trust for the kids or it's to fund retirement or whatever it is, you actually shouldn't look at the price.
Never.
Unless you're looking at it to say, okay, the price fell below my estimate of value, so I'll buy more. But a better way to do that is just pick a period. I say this all the time.
Just dollar cost average.
Just dollar cost average over time. And you know, it's funny, I did the thing, and what it was, 2017 or 18, and it was on CNBC, and while I was on the show, the price went from 10,000 to 8,000, like literally in the 6 minutes I was on the show. And Melissa Lee says, you know, what should I do? I buy it. And just the look of incredulity. She said, well, you just say that no matter what the price, even if it went to 5,000, I'm like, yep, I would. Buy it today, buy it tomorrow, buy it next week, buy it next. Don't buy it all at once. Don't ever buy it all at once.
What is your own belief on the effect of innovation in this space due to the regulations enforced in the crypto market? Do you think enforcing regulation would bring an overthrow to the digital dollar against decentralized currency? Comment down below, and don't forget to like and subscribe. This is the Daily Crypto. We'll see you in the next video.